All right, welcome back. Ryan Miller, Trading Economics. Today we're going to talk about the US Treasury market and how it is not broken. I can't believe I even have to make this video, but here I am. It's been a very popular narrative over the past month or so that the Treasury market is broken, right? Because yields just keep rising as risk assets have been falling, right? If the Treasury market was truly broken, it would be disconnected from its fundamentals. Okay, we're going to get into that in just a second. First, let's try to understand why people think the Treasury market is broken. One of the main arguments is that as risk assets over the past several months have fallen, right? In the blue, we have the S&P 500. The white is the 10-year yield. As risk asset stocks have fallen, yields have risen. Normally, they're in a risk-off environment. When risk assets fall, bonds get bid, and then yields fall with them. Right? It happened here in March 2020. Stocks and yields fell together. Happened in 2007, 2008, happened 2000, 2001, right? So typically risk-off environment, bonds get bid, yields fall alongside of risk assets. That's not happening, right? Yields have been pressured higher as risk assets fall and must be broken, right? Now, the Fed is pressuring yields higher. They're normally not this late to the party in raising rates. So this is why we have risk assets falling at the same time yields are rising. We're going to get more into that in just a second. But another argument is that higher yields, right, higher interest rates are causing things to break. We're seeing significant slowdown in the housing market. Fed raising rates causing other central banks to raise rates. It's breaking things around the world. Look at the Bank of England. Their yields are no ceiling, right? They had to step in and start buying bonds again. Now, things breaking due to higher yields doesn't mean the bond market's broken. It means, well, the system is very fragile, right? There's over indebtedness, right? There's weak growth out there. So that doesn't mean the bond market's broken. There's just other issues, right? And then another argument is that the bond market is illiquid, right? And very simply, that means there's not enough buyers to absorb all the sell pressure. And so bond prices fall and yields rise. Well, illiquid is not the same thing as broken, right? It just means there's just not a lot of buyers right now to absorb the selling. That's what illiquid means very simply. Now, is there a reason for there to be selling, right? Is there a reason for investors, foreigners, whoever's selling to be selling? Right? Without getting into the whole global dollar shortage thing, that would make this video way too long. There is a legitimate reason. That's the Fed, the Fed's monetary policy. We take a look at, in blue is the federal funds rate, and the red is the 10-year Treasury yield. Going back the last 60 years, anytime the Fed is in a rate hiking cycle, they're raising interest rates, yields get pressured higher, right? Fed funds is moving up, yields are moving up with them, right? You can see it very clearly. Anytime there's a Fed hiking cycle, yields get pressured higher, right? Fed's hiking rates, yields get pressured. Fed's hiking rates, yields get pressured higher, right? It's happened, and now here we are. Fed's hiking rates, yields are being pressured higher across the curve. It has literally happened every single Fed hiking cycle. Right? This is nothing new. For the past 60 years, we can see it on this chart very clearly. And when do yields peak and roll over? Well, you can see that pretty clearly too. When we're near the peak in Fed funds, or pretty much at the peak in Fed funds. So until market believes we are near, then maybe a couple months or so, or at the peak in Fed funds, yields are going to get pressured higher. But once we're at or near the peak in the federal funds rate, then yields are going to peak and start to roll over. Okay, this has happened literally the last 60 years, as we can see on this chart. Nothing new is happening here. Nominal yields, nominal bond yields are acting how they should, how they have the past 60 years during every single rate hiking cycle. Get pressured higher when we're at or near the peak in Fed funds, then they will roll over. Clearly, we are not there yet because yields are still getting pressured higher as the Fed is expected to continue raising rates. Okay, so this all makes sense. right? That nominal yields are pressured higher. Okay, now the problem is people who are saying the treasury market is broken are only looking at nominal yields. There's another part to this, to the bond market, right? The yield curve, right? The yield curve. So if we were to take a look at the yield curve, we can see this is the whole back end of the yield curve on the bottom here. Okay, 2s and 30s, 5s and 30s, 10s, 5s and 10s, the 2 and 10. Right, a line moving down means the yield curve is flat or flattening. Right, a line moving up is steep or steepening. And as you can see in the entire back end of the curve, we're in negative territory. Right, negative. Right, we have an inverted curve. Right, the 2s and the 10s are 40 basis points inverted. Right, so the yield curve gives us more information than just nominal yields. As we know, we just saw clearly nominal yields get pressured by Fed policy, but curves, they give us more information. They measure risk in the market. When the yield curve is flattening, right, it's telling us that the bond market expects weaker growth and inflation expectations, right? If there's going to be weaker growth in the future, that means the system's a little more vulnerable, right? There's greater risk, right, to the system. Okay, and then when the yield curve outright inverts, like the entire back end is, that's the bond market's way of saying we expect a recession, right? A recession is likely to occur in the future. I don't think, well, there are some, but not too many at this point are going to argue a recession. But let's take a quick look, see where we are from a growth perspective. Right? I've gone over some of the things about to go over before, but I'm going to link a couple of videos in where I go over this in more detail. But if we take a look at the 4 main components of the economy, the 4 coincident indicators that define the growth trend, real personal income. So we're looking at real growth right now. It's been slowing. Real personal consumption, it's been slowing. Industrial production, been slowing. Non-farm payrolls, right? Employment has been slowing. So if we were to put these together, real growth is somewhere in the 1% range. So very close to that zero bound, right? Meaning we're very close to recession. Now, where are we headed? I went over this in my last video, and I recommend you watching it. Go over this in a lot more detail, how we can use interest rates to give us an idea of where the economy is headed when it's going to turn, those major inflection points. So interest rates are in orange, and they are inverted. And the blue line is the cyclical index, made up of a few housing and construction leading indicators that typically have a lead time on the economy in the 6 to 9 month range. So on an inverted basis, interest rates lead the cyclical index, right? Like I said, I went over this in depth in my last video. I'm going to link that, okay? So here we are, interest rates been rising, right? Showing up as a moving downward on an inverted basis. That's going to pull this cyclical index lower with it, right? So that means over that cyclical index holds about a 6 to 9 month lead time on the economy. So that says over the next at least 6 to 9 months, the economy is likely headed lower. And since real growth's already in a 1% range, recession is all but inevitable at this point. So the yield curve is accurately, per where growth is right now and per the leading indicators, is accurately depicting weaker future growth and inflation expectations and a recession, since we're already very close to that zero bound as it is. So the same people who are saying the treasury market is broken, a lot of those same people are also saying, hey, recession's coming up. Take a look at the yield curve. So they think since nominal yields are rising during a risk-off period, the treasury market's broken. But then they also say, oh, but the yield curve is accurate, right? Doesn't really make too much sense. If the bond market was really broken, I don't think we'd be getting this clear of a picture from the yield curve, right? Across the curve, right? Even the front end is flattening. Parts of it are here, the 2 and the 5s inverted, right? Very close to zero everywhere else along the curve. The entire curve is telling us the economy is headed lower, right? We're headed into a recession. So the yield curve is accurately predicting growth, inflation expectations, recession. Okay, that's not broken. The nominal bond yields are what people think is broken, but as we just saw, per the 10-year yield and the federal funds rate, during Fed hiking cycles, which we're in one right now, yield curves get pressured higher. Everything that is happening right now has happened before. It happens every single cycle, right? Every single hiking cycle, single growth rate cycle. The yield curve flattens, it inverts if we're getting close to a recession. Nominal yields rise during the Fed hiking cycles. When we're at or near the peak, they start to roll over. Nothing out of the ordinary is happening that hasn't happened before in history. In other words, the bond market is not broken. It is clearly not broken. It is clearly not detached in any way from the fundamentals. In fact, it is right in line with the fundamentals. The bond market, not from nominal yields to the yield curve, is doing exactly what it should be doing, exactly what it has been doing throughout history. Okay, so I hope for whoever watches this, we can finally put to rest that the bond market is not broken. It is doing exactly what it should be doing. Okay, so that's my rant for today, at least. If you have any questions, let me know. If you enjoyed this, please like it, subscribe, share, and I will catch you in the next one.